Okay, great. Thanks, everyone, for tuning in. My name is Kevin Carter. I'm the founder and chief investment officer of two different funds that trade on the New York Stock Exchange. Our first flagship fund is EMQQ, which will be 7 years old next month. And more recently, 2 weeks ago, we launched a sister fund, FMQQ, and I will tell you about both of them and why you ought to care about them. So let me just tell you quickly who I am and how I got here. I live in San Francisco Bay Area. I've been here my whole life. I got out of college 28 years ago. I had one interview at a place called Robertson Stephens and Company. They told me I could start Monday. I said, how can I possibly start Monday? I don't know anything about investing. And the person interviewing me said, go buy this book. And he wrote down A Random Walk Down Wall Street. Now, some of you probably have this book. Some of you probably have read this book. It was first published in 1972. And in that first edition, the author suggested that somebody should make an index fund because there were no index funds back then. And a couple of years later, his friend John Bogle did, in fact, do that. And so this book and its author are all about indexing and efficient markets. And that's what I read over the weekend before I showed up to work on Monday in January '92. But I very quickly gravitated towards Omaha, and I try to think about every business and investment decision through an Omaha lens. But for the last 22 years, I've been partners with this guy. So I've had 1 foot in the active world, 1 foot in the indexing world. The first company that Bert and I started in 1999 was a fractional share brokerage that allowed people to invest in dollar amounts versus share amounts. And that company was acquired by E-Trade in the year 2000. And then the following year, we started a company called Active Index Advisors, which was a pioneer in what's now called direct indexing. And we sold that company to Natixis Asset Management in December of 2004. But just a few months before that, Google went public. And when Google went public, they asked my partner, Bert, if he would give a talk to their employees about investing. And I wasn't invited, but I heard about the talk from Burton. And a few months later, my phone rang, and it was a guy at Google who had Googled me. And he said, hey, I heard about this active S&P 500 you manage. How do I invest? And I said, well, you'll need an investment advisor because we're only available at Morgan Stanley and Credit Suisse and Deutsche Bank. And he said, well, I don't want an advisor. I'd rather just invest directly with you. And one thing led to another, and I ended up becoming the investment advisor for about a dozen of the earliest Google engineers. And so that's spring of 2005. And then while I'm going back and forth down to Mountain View, Burton has started going back and forth to China, and he ends up writing a book about investing in China. First, he wrote a white paper, and the Google people heard about it and called me and said, hey, can Burton come down and talk about investing in China? And 15 years ago, we drove down to Mountain View, and Burton gave his talk about China. And all these people at Google looked at me and said, we want to invest in China. And I had never been to China at that point, and I didn't really know much about it other than what was in Bert's white paper. But somehow the last 15 years, the only thing I've done is try to figure out what does that even mean to invest in China and more broadly in emerging markets. So let me tell you what I learned. First, just to put some scope on it, when we talk about emerging markets, whether it's population or GDP or stock market cap, this is about 60% a story of Asia, with China being the largest part of that. It's about 20% the emerging Americas, with Brazil and Mexico being the largest part. And then it's about 10% the Middle East and Africa, and 10% Eastern Europe. So that's what it looks like sort of on the map. We include frontier markets in our definition of emerging markets. And the reason you should care about these places is that they basically are the world. They're 85% of the world's people. They're even more of the future as measured by young people under the age of 30, for which they're about 90% of the world's population. as the left side of this slide shows, the GDPs of the developing world are now bigger than the developed world. They've been growing about twice as fast on average. But if you look at the right side of this slide, you'll see 3 red arrows showing you what the emerging markets share is of different categories. The top red arrow is pointing out, again, this is where all the people are, but the bottom 2 red arrows are pointing out that in the consumption categories, emerging markets are way behind. And it's the closing of that delta between that top bar and the 2 lower bars. That's the story. The thing that is emerging are the people, billions of people moving on up, and they want stuff. And that's what everybody should be focused on. It's what I've been focused on for 15 years, and it's what EMQQ and FMQQ are both all about. So we'll come back to that. Now, let me tell you, the only other thing you need to know besides the consumer is what you want. The only other thing you need to know is that traditional indexes and the ETFs that track them are terrible ways to make money investing in emerging markets. And this is something that I learned about in the first 5 minutes when I got back to the office from Google 15 years ago after Burton's talk. I went over to the portfolio managers when we got back and I said, look, the Google guys want to invest in China. Give me a list of all of the companies in the iShares China ETF, FXI, the ticker symbol. That was the only China ETF available back then, and it was pretty new. And so I assumed that's what we would use to invest in China. And I asked for the list of companies because with my Omaha hat, I like to see what exactly we own. And so I asked for the list. Before they gave me the list, Burton pulled me aside and he said, look, when you get the list of all the companies in the China ETF, you're going to see that most of them are Chinese government-owned banks and oil companies. And I said, yeah, I've heard about that. That doesn't sound great. And he said, well, let me give you an example of how these things work. And the example was this. You've got a Chinese manufacturing plant with 15,000 employees. It's been losing money for a decade. It's totally inefficient. It's about to go bankrupt. It goes to the state-owned bank and says, hey, we need more money. Now, a normal banker would say, no, you're bankrupt. But the state-owned banker doesn't say that. The state-owned banker says, well, if you run out of money, then your 15,000 employees are going to be out in the streets protesting. And so the bank makes another loan. Now, when Burton gave me that example, it made me literally nauseous in my stomach because with my simple Omaha brain, earnings equals value and the growth of earnings equals the growth of value. And if you're telling me that the people that run these companies don't care about that, why would we invest in them at all? And in the case of the China ETF back then, it was 80% state-owned enterprises and less than 10% in consumer companies. So this is a real problem. It's a big problem with the broader index. It's not as bad as the China indexes, but it's about a third of the MSCI and the FTSE emerging market indexes, which are what the iShares and Vanguard funds track. And in addition to having conflicts of interest and being inefficient, poor corporate governance is putting it very, very mildly because the corruption is rampant and it's in the newspapers every week. And this is the best example. Petrobras, the Brazilian oil giant, that was systematically looted of billions of dollars by a lot of people, including the last 2 presidents of the country, who basically stole your money if you're using a traditional broad product, a traditional broad emerging markets index to get your exposure. And any of the smart beta things have the same problems. They just sort of change the weights. They don't recognize that they have these giant allocation to these sort of a cancerous group of companies in emerging markets. So it's 30% of the big index. It's even more, it's about 50% of the index if you count the former Soviet SOEs, which are now controlled by the oligarchs and the chaebol. And these companies have a lot of the same problems, including people going to jail like this guy. This is the former chairman of Samsung. He's been in my slideshow for a long time. I may have to update the slide because he went back to jail yesterday for the third time in about 6 years. One of those times he went to jail was for bribing the president of the country, who also went to jail. So this is why you really can't expect to make a lot of money using these traditional products. And I find it always so interesting when I see these otherwise credible investors that have deployed serious amounts of money to this horrible group of companies in a hope to capture the growth in these markets, but buying products that really don't do that. There is growth. You're just not going to capture it if you're doing, well, what Bridgewater's doing. So you got to evolve and do what we call emerging markets 3.0. Now, this is something I saw play out in my first 8 years on the China scene. Bert and I launched a number of China ETFs with Guggenheim, but when I wasn't working with the Guggenheim people, I was in New York City and Boston with family offices and endowments and foundations, and I watched how they were increasing their allocations to emerging markets. But as they got bigger, up over that 10% weight, they get a little bit more targeted. They see they're not making any money. They see people going to jail, and they decide they need to try something a little more specialized. Now, the best example of that was David Swensen in Yale. Took a young Chinese analyst that was working in the endowment and who was an alumni and seeded him with $50 million and sent him back. They formed a company called Hill House, which some of you may have heard of. It's been quite successful, to say the least, for both Yale and the people at Hill House. But most people weren't David Swensen and didn't have $50 million and weren't Yale. And so what I finally concluded is that investors should just buy the emerging market consumer sector. Leave out the banks, leave out the oil companies, the corruption, the legacy economy, and just focus on this, the biggest growth opportunity in the history of capitalism, according to McKinsey and Company. And because again, what's emerging in emerging markets are the people. There's billions of them. They're moving on up. And they want stuff. They want the stuff that we take for granted: more and better food, more and better clothing, appliances, entertainment, vacations, cars. And they want their kids to go to Harvard. And that's the story. It's very well documented, and it is what everybody should be focused on. Now, as I mentioned, I launched a number of ETFs with Guggenheim in those first years, and now have the Invesco brand on them. But when I wasn't working with the Guggenheim, or rather, after 8 years of doing that, I decided I woke up one morning and I looked in the mirror and I thought, what on earth have I done? I was this young, cocky Charlie Munger wannabe, and somehow I got mixed up with this Princeton guy, and now I'm making Chinese index funds, for God's sake, and I need to get out of here and go back to my roots. And so I told Guggenheim that's what I was going to do, and I set up an investment partnership. And once I had it all organized and my account open and funded with my own money, I bought 5 stocks. And all 5 of those stocks were stocks that I thought were good ways to invest in this emerging market consumer wave. And after a little while, I thought I should go see if any of my friends want to invest in this fund with me. And so I made some slides one morning to show the people what I was doing. And one of the slides was a list of the 5 companies that I had invested in. And I looked at the slide after I made it, and the first 3 companies were all emerging market consumer stocks, and they were all part of the emerging market consumer ETF, which I told people to buy when they asked me what's the best emerging markets ETF. Buy the emerging market consumer stocks by purchasing Econ, the emerging market consumer ETF. So 3 of the stocks that I owned were from that fund. Those companies trading in Hong Kong were Want, which is like the Nabisco of China, branded crackers and snack foods. And then I bought 2 other Chinese companies in Hong Kong, sportswear companies, Li Ning and Peak Sports. You can think of these as the Reebok and Converse of China. So those were the first three companies I put on my slide. But then I had two other companies that were clearly part of the emerging market consumer story, but the database didn't say that. The database said they were technology companies. Those two companies trading in the United States were Wuba, which is like the Craigslist of China, which has since gone private. And then the fifth and final company trades on the NASDAQ. It's called Mercado Libre, MELI. And I looked at the slide after I made it, and I thought, well, all of these are great investments to play the emerging market consumer. The first three, the food and clothing companies that are called consumer companies, they're fantastic. They're growing at 15 or 20%. I think they each have a moat in form of brand equity. But then I looked at the two technology companies, and they were growing at 100%. And in the case of Wuba, it had a 94% gross margin, where when I'm looking for moats, I'm looking for high gross margins, and they had the highest I'd ever seen. And even Mercado Libre had quite nice margins. And I looked at them, and I thought, well, they were growing faster, their PEs were higher, but the PE divided by the growth rate, the PEG ratio, which is the only multiple I care about, the PEG ratio was actually quite reasonable. And I just remember thinking, my two best emerging market consumer investments aren't even in the ETF that I tell people to buy. And that was it. I had that thought. I went to my meetings. I got some checks. I was heading home, and I was at a stoplight, and my phone rang. And it was a friend of mine with a 3-year-old daughter. And she said, "What's the best emerging markets ETF for my daughter's college fund?" I started to tell her to buy the emerging market consumer ETF, because that's what I always told people that asked me that question. But I stopped and I thought, wait a minute, the best one doesn't exist. And I went straight back to my office and I started to organize EMQQ, and it launched 100 days later on November 12th, 2014. So I didn't understand exactly what was happening. Let me tell you what's happening and why you should care. I could see that no matter what you called these companies in the database, that what they were really doing was serving these billions of consumers in the emerging markets. I could see the growth rate. I could see the valuations were quite reasonable and the margins were quite nice, but I didn't really appreciate what was driving the growth. And now it's very clear to me. And what it is a combination of three different mega trends, three giant one direction secular trends, all of which we're part of, but we were first. And so we don't perhaps quite appreciate how important these things are and realize that most of the world is just now getting involved. So what are those three mega trends? Number one, all of the rest of the world's people want the same stuff that we take for granted: more and better food, clothing, appliances, vacations, etc. Biggest growth opportunity in the history of capitalism, according to McKinsey. Now, we've had a consumption economy for generations, but it's just now getting to everybody else. Now, when I got that call 7.5 years ago from my friend, I answered it on my iPhone, which was on the car seat next to me. So I had a smartphone back then, but it was pretty new to me. I had only had it for maybe 2 years at that point, and I could already see how it was changing my consumption. Back then, my family had been going to this store 4 times a week, which was easy to do. It's only 3 miles from our house, and the roads are paved, and we have a car, and there's free parking. But I was noticing that all of a sudden, this guy was coming to my house once a week, and then twice a week. Now, my family goes to this store maybe once a month. This guy, Mark, is at my house every day. There's a very high chance I will see him when I walk out of my studio here and go upstairs and move along with my day. So you've seen how this device has changed us. Well, you know, I had a computer for 20 years before I got a smartphone. Well, the reality is most of the world didn't. And so all of these people are basically leapfrogging from no computer to supercomputer in their pocket. And so the computer is the second mega trend, and it will not be on these people's desk. And in most cases, it doesn't have an Apple logo. What we're talking about here are $60, $80, $100 Android-based smartphones made in China, and they're bringing the computer to the world for the first time. They're getting better every year. They're getting more affordable every year, and they bring the third mega trend with it, something I think we take for granted, something I've had for 25 years. That's called the internet, which I first got in 1995 on a dial-up telephone modem in San Francisco's Marina District. And then it went to the cable, and now it shows up in my pocket. Well, most of the world never got wired. So not only are these people getting their first computer, they're getting their first access to the internet. And because they lack the traditional consumption infrastructure that we take for granted. And when I say consumption infrastructure, I'm talking about bank accounts with debit cards in everybody's pocket, talking about cable televisions on the wall, and I'm talking about Target stores. Because those things don't exist by definition in emerging and frontier markets, the leapfrogging that's going on is huge and creating what I am pretty sure is not only the fastest growing sector in the world today, but the fastest growing sector in the world ever in terms of public companies and their revenue. You can see here the EMQQ companies, of which there's 118 today. You can see that their average growth rate over the last 11 years has been 37.5%. Now, I'm not 100% sure of anything, but I've given this presentation to thousands and thousands of investment professionals. I have offered a $100,000 cash reward to anybody that can show me a sector that grew at 38% for 10 years, which is what it did from 2010 to 2020. I could be wrong. I've asked everybody I know that's smarter than me and more experienced than me if they can think of a sector that ever grew at 38% for 10 years. And so far my inbox is empty. So I could be wrong, but I'm pretty sure I'm not. So this is it, massive growth. And what comes with that? Value creation. You can see here over that same time frame in gold how EMQQ and its companies have done. Bouncing along the bottom in blue, you can see how the funds that Bridgewater are using have done. Not much of anything. A 62% return over 12 years, all of which came in the last 18 months. And actually, if we made this a 14-year chart, investors using the funds that Ray Dalio is using, they just got back to break even. And I think that the problems I talked about with the indexes, there's several other problems, by the way. The biggest one is the SOEs, but I think that this emerging market category is the largest value trap in the world, because people look at the MSCI index and they say, look how cheap it is. It's selling for 12 times earnings. So it's, the S&P selling for twice that. So it's half the cost of the S&P 500, and these economies are growing twice as fast. So how can that not be a bargain? Well, if you knew what the Agricultural Bank of China was, you'd probably think a PE of 12 is too high. So I'm not optimistic that this emerging market category, as defined by the broad indexes, is ever going to make people the kind of money they're hoping for. And I'll tell you one other problem in a second, or right now, I guess. So who are these companies? So Alibaba is the best known of the emerging market internet companies. It was the largest IPO in US history, which is funny to think about, a Chinese internet company on the New York Stock Exchange. And now, most of these companies historically have gone public here in the United States. And one of the other problems I encountered on my first day, after we got back from Mountain View 15 years ago, and I asked for the list of stocks in the China ETF because I wanted to look at them, and Burton said, watch out, it's all state-owned enterprises. But then I got the list and I got to the bottom and I said, where's Baidu? Because Baidu had also recently gone public and it wasn't in the China ETF. We called the iShares people and said, hey, we're going to maybe put some money in this FXI. Where's Baidu? They said, we don't own Baidu. I said, I know, I can see that. Well, why don't you own Baidu? They said, well, we don't consider it a Chinese company. And I said, okay, well, it's the only Chinese company I know. It's the Google of China, and being the Google of anything seems like a good idea. And being the Google of the biggest country in the world seems like a really good idea. And they said, well, we don't consider it a Chinese company because it trades on the New York Stock Exchange. I said, all right, well, that's the stupidest thing I've ever heard. So I complained about this problem for a decade. People thought I was crazy. Why do you care about this? Because when this gold line was going up, the companies in it were not in the blue line. The MSCI index and the Vanguard fund, the iShares fund, didn't own any of these stocks. They didn't own Mercado Libre. They didn't own Baidu. And they didn't own Alibaba. Now, it took them, now, thank goodness Alibaba got so much coverage because Consumer Reports and the USA Today both wrote stories about this little weird nuance of indexing that I found troubling. And finally, it was on the front page of the business section in major outlets. And now, in spite of that, it still took 3 years for iShares and Vanguard to add Alibaba. So now, why do these companies list here? Because they have, these companies are getting funded by US institutional investors. They're getting funded by Harvard and Yale and Stanford. By the way, if you saw the returns that they just, all of those big endowments put up last year, I suspect that a very large percentage of those returns came from EMQQ and FMQQ type of investments, emerging and frontier market internet investments. But this is why these companies trade here, because they've been backed by our biggest institutional investors, and they want to list on the best exchanges in the world, which are here on the NYSE and the NASDAQ. And you had Jerry Yang, for example, put $1 billion from Yahoo into Alibaba. He kind of got fired for that move, but it turned out to be the best thing that they did and was all they really had left of value at the end. I think it was a 50 bagger. And then in my favorite story from the last couple of years, this Brazilian fintech company Stone came public, and my heroes in Omaha bought 5% of the company on the IPO, which I think was their first IPO investment ever. You won't find Stone Co. in the big index funds. You will find Petrobras, the corrupt oil company, twice, 2 different listings in the big indexes, but no Stone, missed by the indexers. Now, Tencent's the other so-called Chinese super app, not as well known as Alibaba, but getting pretty close. Trades in Hong Kong. To make it simple, we've always told people it's the Facebook of China, and the WeChat app is the social network. But very importantly, you can't call Facebook the Tencent of anything. And the reality is that a lot of these companies in the emerging markets, they don't have a US equivalent, because in the developing world, as I mentioned, the consumption infrastructure is underdeveloped. It's allowing these companies to basically go into every consumer vertical and compete in a smartphone enabled way. And it's really not, it's really better to think about Alibaba and Tencent and all these other companies, not as technology companies, but as consumer companies operating in all verticals with a smartphone centric world. And so healthcare, Alibaba's healthcare business, publicly traded separate company. JD.com IPO'd their healthcare business last year. Tencent will IPO their healthcare business. Entertainment, what's the Spotify of China? It trades on the New York Stock Exchange. Tencent Music and Entertainment. Food, the stuff happening with food and groceries in China, we could do 2 hours just on that, but there's amazing stuff. This is the most amazing thing I've ever seen in China. This is Alibaba's grocery store, Hema, closest thing I've ever seen to the Jetsons, but it also looks a lot like Whole Foods. Now, the final part of that is money. The fintech part of this story is so big, hard to overstate, and it's happening all over the world. China is almost fully digitized now on its money, and it starts with payments. Every place in China, you're going to find those 2 QR codes that are in the red circle on the bottom. That's the green one from Tencent, the blue one from Ant Group. Everywhere you want to buy anything, you're going to find those QR codes. So fintech is a huge deal, and we'll talk a little bit more about it, but we're getting left way behind in fintech. So now there's other sort of second tier Chinese companies that most of you are probably familiar with: JD, Pinduoduo, Meituan, of course, Baidu. So it's not just Alibaba and Tencent, and there's dozens of other mid-sized internet companies from China as well. But let's talk about what's going on beyond China, because while China's been in the news with lots of drama and stuff I think is overblown, there's so much going on in the internet and e-commerce world beyond China, and it's about to get really, really, really big. So let's talk about what's happening beyond China. So first of all, China's e-commerce market, I don't think people realize it, it's the biggest in the world by far. It's not even close. It is only going to get further ahead. And if you look, there's 46 countries, 46 emerging and frontier markets in our universe. China's e-commerce market is 4 times as big as the other 45 combined. So EMQQ has been very much a China story. It's always been about 2/3 of our portfolio, and even more of the revenue part of the story. But there's so much going on in the non-China part of this, which we call the next frontier. And you can see, here's the revenue again that I showed you earlier, but broken into 2 different pieces. You've got the China part in blue and the beyond China, FMQQ, in gold. And you can see on the far right that the revenue for this group beyond China is now passing 100 billion. Literally, as we speak here, this quarter, that's where China's internet companies were 6 years ago. And you can see they passed 100 billion right after we launched EMQQ and have gone on to grow significantly. We've seen what's going on in these companies. Mercado Libre has been one of the companies that inspired EMQQ and has doubled twice in the last few years, largely because of the fintech business, which has really, really been on fire. You won't find this company in your broad index funds or ETFs either. This one is missed. The database will say Argentina for this company, but it's generating revenue in literally every country in Latin America, even those that aren't even considered frontier or otherwise categorized for investing. So Mercado Libre has been a strong performer. This is, I think, the best performing stock in the world, C Limited, which we added a couple or 3 years ago when it came public, trades on the New York Stock Exchange. This is a company in Singapore. So the database and fact sheet will tell you this is Singapore, but this is revenue from all over Southeast Asia. This is in Vietnam, Thailand, the Philippines, Indonesia, Malaysia, all over Southeast Asia. And this company does not have a US equivalent. It's got 3 different apps: gaming, e-commerce, and payments. Shopee, the shopping app, actually is also the largest shopping app in Brazil. Eastern Europe's Yandex been part of a portfolio for a long time. It's always been the Google of Russia, and now it's the Uber of Russia, having beaten Uber. Uber did leave Russia, took a minority stake in Yandex Taxi, which will come public likely soon. Africa's got Jumia trading on the New York Stock Exchange. This is a Nigerian e-commerce company that operates in several other African countries, and perhaps the most volatile stock I've ever owned. And this one's interesting. Andrew left, the short seller who blew the company up not long after their IPO, came back and issued a strong buy report, sometime last year. Anyhow, this is a very volatile stock, but the best exposure you can get to Africa. But the IPO drumbeat is accelerating, and it's getting, as I'll show you, going to be very exciting. Poland's e-commerce leader, Allegro, now the largest company in Warsaw. Kazakhstan, yes, there is a publicly traded Kazakhstan super app in London. It's actually, I think, performed quite well since its IPO. So this story is everywhere and spreading. Uruguay, this is one of my favorite companies. This is a company that is in Uruguay, but it operates a payments platform or a sort of a fintech back end for all emerging and frontier markets, and is profitable and growing at 100% and trading on the NASDAQ, D-Local. Turkey's e-commerce leader, founded by a woman, Hepsiburada, now publicly traded as of only a couple months ago. Indonesia's e-commerce leader, Bukalapak, public 2 months ago. This company marked a milestone. This is Zomato. This is the Indian food delivery giant that is experiencing incredible growth. And it marked a very important point. It was the 60th non-Chinese internet IPO, FMQQ, if you will. And that means there's now more non-China internet companies that are publicly traded than China companies. That number doubled in the last year from 29 companies to 60, and it tripled in the last 2 years from 20. And it's not slowing down, it's accelerating. And we're going to see a gusher, basically, of IPOs, possibly. We could have as many as 25 from India alone, and that's gonna start very quickly. Zomato did happen, but there's a lot more coming. Let's look at a couple of them. This is the Indian fintech leader Paytm, which Alibaba is the largest shareholder of. And Berkshire Hathaway is also an investor in Paytm. And this company may be public in less than 3 weeks. So you'll hear about it when it does, but it looks like they're targeting first week in November. And it's good to be the fintech leader in India. The government is very set on digitizing their financial system. They're taking some currency out of circulation, and you have a very large unbanked population. So Paytm coming public. This one won't probably happen until Q1, but this is the e-commerce leader in India, Flipkart, which Walmart controls and counts Tencent also as an investor. This company should come public in Q1. Beyond India, we've got this fascinating company. This is GoTo, which is a recent merger of two companies, Tokopedia, which is like the Amazon of Indonesia, and Gojek, which is like the Uber of Indonesia. So Tokopedia and GoTo are merging to form GoTo. And this combination of companies is fascinating, but individually these companies are fascinating because Gojek has been long considered the most innovative of all the ride-hailing apps globally. First of all of it takes place on motorcycles and mopeds. So their logo is a moped, and they're going to give you a nice helmet with their brand, their label on it to ride around it. But this is the first company to combine all sorts of features. They were the first to move people around, but they also, at the beginning, delivered food and packages. So it's really like, it's more like a combination of Uber and DoorDash and FedEx Ground. And because when they launched their ride-hailing app, most people didn't have any form of digital payment, they actually started a payments platform, which has grown to become a pretty valuable additional business in fintech, which is a pattern we're seeing in a lot of these companies where they start a payments platform to facilitate their business, and then that payments platform becomes its own business. And that's happening quite a bit. And I think we're going to see more of that in these fintech businesses get spun out of the bigger companies. So anyway, GoTo should come here by the end of the year. Now this one in the news yesterday, this is one I'm quite excited about. This is Nubank, the largest online bank in the world in Brazil. It counts Tencent as an investor, and as of this past summer, it counts Berkshire Hathaway as an investor. So the third EMQQ, FMQQ fintech investment for Berkshire in the last year and a half or so. And this company, Nubank, it's half the size of Wells Fargo in terms of accounts. It's growing at 50%. And they announced yesterday they are now profitable. So this will be a big, big IPO when it happens, likely in the United States, likely sometime before the end of the year. So what is happening is quite exciting. And I think one of the things that we enjoy about it is that it's really changing people's lives. The way this is happening, these people that are getting their smartphones today, and in India, that's 3 people a second. These people are like going from 0 to 100. These are people that didn't have access to information, to news, the ability to communicate with their friends and family easily. And so it's quite exciting, and it's fascinating to see how it changes people's lives. And in India in particular, it's it's happening very fast. And so anyhow, this is I guess the conclusion here, that EMQQ is a story of growth. It's explained by this great confluence, this a combination of 3 mega trends happening at the same time. Billions of people just now becoming consumers, just now getting their first computer, just now getting their first access to the internet. And because they don't have a strip mall and a bank account and a car to drive to them, these people are leapfrogging. And that is part of what explains this phenomenal and perhaps unprecedented growth rate. Side benefit, in a part of the world where corporate governance is your biggest problem, you get better corporate governance here. And you also get exposure to the frontier markets and a lot of private companies that Alibaba and Tencent have invested in. Now we've got a crisis in China recently, and I don't think I could not make some comments about it. It's, to be honest, all I've done for 3 months is talk about the Chinese government, which is, as I know, has been something that has been part of my life for 16 years. Ever since I got involved with China, the number one thing that I hear from or deal with US investors, almost none of whom have ever been to China, is that everybody's afraid of the Chinese government. The evil Communist Party is going to steal all my money. Now that's kind of that's a very general, very generalization of what this fear is, but it's kind of a constant, and it's always been around, and nobody really can alliterate a specific thing usually they're afraid of, but just this general fear that the Chinese government's going to do something and I'm going to lose all my money, and so it's kind of happened here recently, and now I don't think it really happened, but I understand why people took some of the Chinese actions as very negative. I don't think they should, but they have. So let's talk about what's happened in this crisis, which in Chinese is a combination of 2 words, the words danger and opportunity. I think this is a big opportunity. We've had a 38% decline since February in EMQQ. And it's not the first time we've had a 30% decline. We've had several, and we will always have them. They are part of investing, particularly in a group of companies like these. So we've had 30% declines in the past. And we've just had one of our bigger ones that was as high as 38%. Now, what caused it? Well, the first part of it, the sell-off, which started in February, there wasn't anything to point to. There was no Chinese actions there. It was really just that rotation from, sell Zoom and buy Carnival Cruise Lines or whatever kind of happened in the market back then, but no specific China stuff. But the last part of this chart very clearly started the first week of July when the DD IPO happened. The next day, the Cybersecurity Administration announced they were going to launch a review. And then over the weekend, they pulled the app from the App Store. And on July 6th, when the market reopened, Tuesday, after the holiday, everything gapped down. And there was a vacuum of information. Nobody knew what was going on. There were rumors. There were people making their hyperbolic statements, like Jim Cramer. And the company, DD, was forced to issue a statement. People were saying that they hid this information. They must have known that the regulators were going to launch this investigation, and they obviously rushed to the IPO. And DD was forced to issue a statement, and their statement was, we did not know that they were going to launch an investigation, and furthermore, that we got mixed messages from the regulators as to whether or not they were comfortable with our going public. And what the DD situation revealed, it left egg on three faces: the DD management team, the investment bankers, and the Chinese regulators. Because when DD said they got mixed messages, that was true, because China lacked a single point of exit by which these companies could make sure that all of the different regulators were okay with their plans. Because in the different regulatory things we've seen in China, going back to last November, there's been 4 different regulators and an uncoordinated approach. And the analogy I give is, when you go to a foreign country, there's a very clear process. And it ends when they stamp your passport and hand it back to you, and you're free to go. Well, China lacked that. They realized it, and within a week they had put in place at least a preliminary system by which these companies could be sure they were good with all the different regulations that they were and are subject to. So nonetheless, it really scared people, because because the Chinese government was involved, and as I said, everyone's always afraid about the Chinese government, and they're coming to take all your money somehow. And that just put people on edge. Now, then this happened, Friday, the 23rd of July. I was wrapping up a week in Mexico, sitting by the pool with my colleagues, when this story broke. Rumors that the Chinese government were going to crack down on the online education business, the tutoring business. And that was the rumor on Friday. And part of the rumor was that they were going to force these companies, at least the major, the ones teaching the core curriculum, they were going to have to do it in a not-for-profit basis. And that, well, when I saw that news, first of all, the idea that they were going to try to clean up this really dysfunctional online and after-school tutoring frenzy that's taken over China, where all of the kids are going to school when they get home from school and going to school on the weekends, and it costs money, and it's a very it's a big point of pain with the average Chinese person, what's happened with the education system. And so it shouldn't have been a surprise, because the government's talked about what a problem it is. And even in March, Xi himself talked about what a problem this for-profit education industry had become. And so the idea that they were going to crack down on it shouldn't have been a surprise. I was a little surprised with the idea that they would make them go not for profit. I shouldn't say I was surprised. I knew if they did that, it was going to blow up people's brains. It was going to be, as this headline said, nuclear, because as I mentioned, everybody's fear has always been the Chinese government are going to do something and I'm going to lose all my money. And it happened. It happened with this. If you were an investor in Gaotu Technologies or Tal Education or New Oriental Education, then yes, the Chinese government did something and you lost the majority of your value in those equities. And so that happened. Now, if you understand what's gone on in China and understand the social pressure, you might not think as evil in what happened. And basically what's in China, the school children today have this family structure, which involves 2 sets of grandparents, 2 parents, and them. And the hopes and dreams of those 6 people, the parents and grandparents, are all in the future of this one child. And so, and most importantly, it rests in how that child does on the high school exit exam, the Gaokao, which determines if they get into school and where. And so for years and years, these people are deploying their incomes back into more education because everybody's doing it and they have to keep up. 75% of the school kids are. And there's a feeling that the rich are able to do this and win because they're rich. And the farmers that are saving all their extra money to send their kids to school are at a big disadvantage. And that whole issue blew up last year in May when a 35-year-old woman who was the daughter and granddaughter of farmers in Shandong, who had taken the test 15 years ago and waited through the summer to get an acceptance letter and didn't get one. And her family dejected, all of their investment and hopes and dreams in their daughter being the first one to go to college were all for naught. And she went into the city and became a waitress. And then last May, decided she wanted to attend the community college and take a class, and she registered or went to register, and they said, "You're already in the system." She said, "No, I'm not." They said, "Yes, you are. You graduated from Shandong Tech 12 years ago." And she said, "No, I didn't. I wanted to go to Shandong Tech." And they said, "Well, is this you?" And she said, "That's my number, but that's not my picture." They launched an investigation, and it turned out hundreds of children of poor families had their acceptance letters stolen at the post office and repurposed and otherwise paid for by rich people. And hundreds of kids had their lives stolen, basically. And this caused a huge uproar. Now everything's digitized now, so that can't really happen anymore. But so it's hard to explain to Americans the intensity of the education for the Chinese children. But anyhow, the Chinese government dealt with it in a way that they thought was best. I don't think it's going to solve the problems they're trying to solve, but either way, it freaked people out. And I understood why. Their fear that gripped investors in Chinese internet companies was so intense. It was the most intense fear I had ever seen. Steve Roach was disturbed. Kathy Wood, still smiling, sold all her Chinese internet companies. And I loved it because people were so fearful. I literally had never seen so much fear. And when I was young, they told me to buy fear. And fear was everywhere and it was for sale. And so I was a happy buyer. And now we did get back to those $48, $49 lows a couple times after that, but never with the intense fear that we saw. And the irony here is that really what we're seeing in China is what we're seeing all over the world. These enormous tech companies have become so important and so powerful, and no regulators have been able to keep up. And this isn't a China story. This is on the front page of the New York Times. The same day that everyone's running around with their hair on fire about the Chinese government, the front page of the New York Times tells you that the president has got his new best lawyers to attack Facebook and Google, et cetera. So I'm not that worried about it. This is, to me, just a lot of noise. The first 2 actions that the Chinese government took with the Ant Group IPO and monopoly issues, those didn't bother me. In fact, I thought they revealed a strength that China has, which is the ability to quickly and decisively do stuff without all the lobbying and special interest groups and hearings. And I thought the way they handled that was the Ant Group situation. I thought they had to stop that, and they handled it well. It cost, every piece of Chinese fintech equity probably lost about 30%. So we have approximately 5% fintech exposure. So 1.5% loss, if you will, from that. The antitrust issues, those were no secret to anybody, that these companies were, somewhat actively violating the monopoly laws, and partially because Alibaba and Tencent existed for almost a decade before they even had monopoly laws in China, and they threw their weight around all over the place, and picked and chose winners basically by investing in the smaller platforms, some of which are now enormous as well. So anyhow, these first two issues didn't bother me. The Didi situation, that still remains unresolved. There hasn't really been any fine of any significance yet. And the for-profit tutoring thing, that doesn't bother me. We didn't have any exposure to the big three online education companies. I understand why that looked and felt like people's worst fear, and that's crushed the valuations. But I'm with Ray Dalio on this, at least, that these people are smart. They understand capitalism better than anybody. They've benefited from it more than anybody over the last 30 years. So I don't think they're giving up on capitalism, but the market does seem to think so. Valuations are quite reasonable, and it's pound the table time around here. PEG ratio well below 1, and perhaps a third of the S&P 500. Even after our 40% decline, we are still number 1 by a lot since inception. And if we come back in 5 or 6 or 7 years, I'm pretty sure, even if we started the clock over again, we'll be number 1 again, or number 2, because we have something new that we just launched 2 weeks ago that I think has a chance of beating EMQQ, and that's called FMQQ, or what we call the next frontier. And basically it's EMQQ without China. But since China's 65 to 80% of EMQQ, if you do EMQQ ex China, you've lost almost all of what you were. So we're not calling it ex China, but that is what it is. We're taking all of the non-China companies and those stocks, which, as I mentioned, now total 60. It's a group whose revenue have just passed $100 billion. Again, that's where the China part was 6 years ago. And consider these next two slides. There are 4 times as many people in the next frontier countries. All right, that purple revenue bar has 4 times as many people as the blue part of the revenue bar. And the e-commerce penetration rate is 5% versus China, which has an e-commerce rate, excuse me, of 25%. So 4 times the people, 1/5 the penetration. I have a feeling that purple part of the revenue is going to go up a lot. And I mean a lot in the next 10 years. So I don't know which of these versions of the internet in the developing world will win, but I'm pretty sure there'll be 1 and 2. So that's the end of my talk, Michael, and I can hang around and do a few minutes of questions.
That sounds great. Excellent conversation today, Kevin. Thank you very much for doing it. So could you share the presentations and recording? Let's start easy.
Can we share? Of course, we'll share our presentation. And I don't have, maybe I should tell people how to get a hold of me or us. I'll put it in the chat.
Yeah, put it in the chat, and I'll also share it with them when we're doing a follow-up. We'll be sending out a recording of today's presentation, and then whatever like you have as far as you know, a PDF that we can include with that as well. So let's get into let's see. Chat. All right, what is the average valuation of FMQQ?
Okay. I apologize that I don't have that in this slide. The valuation's quite good, actually. Let me show you the EMQQ numbers. So the FMQQ PEG ratio is like 0.86. It's closer to EMQQ. It's a little bit more than EMQQ, which again, that includes, it's the same stocks that are in EMQQ minus the China ones. So the China ones have a lower PEG ratio. The PEG ratio is again about 0.86, and the numbers are the revenue growth for this year for the FMQQ group is going to grow about, I want to say 43%. So it's growing a little faster than the EMQQ larger basket, and the PE is in the high 30s. So it's got a slightly higher growth rate and a slightly higher PE, but a PEG ratio below 1.
Got you. How big is the potential universe for the frontier markets in comparison to China from a investable securities?
Well, as I mentioned, there's now more. There's now more non-China companies than China. But the China ones are bigger. So, and Michael, I'm going to probably add a few of these valuation slides to this deck before I send them to you and to other people that asked. So my apologies for not having them included. But so there's right now, like just in the last month or two, there's now more non-Chinese companies than Chinese. Their market cap collectively, I think, is about half of the size of China. So China is still quite a bit bigger, but the pipeline of IPOs is just booming. And as I mentioned, I mean, we could have 25 India IPOs in the next 2 years. And I just saw a great piece from Goldman Sachs, a short video yesterday, and they think there could be 120 Indian internet or internet related IPOs in the next 3 years. So it's hard for me to imagine hundreds, I guess. I mean, I think there could potentially end up being hundreds, and likely will end up being hundreds of emerging market internet companies that are publicly traded. I mean, we've had fundings of unicorns in Pakistan, in Bangladesh in the last month. So this story is spreading, and there's a lot of people out there, and a lot of entrepreneurs.
So Kevin, what's the process to get an FMQQ approved on, all the platforms that EMQQ is on today? What do you see for a realistic timeline for some of our, RIAs and broker deals being able to purchase?
Yeah, that's one of the challenges with a new fund. You got to get approved so people can access it. So right now, we're working with the wirehouses, and they all have different hurdles, and some of them are more strict than others. And those hurdles might be assets. They might be, just how many months or, a year of trading or 6 months of trading, 50 million of assets, 25 million of assets. They're all a little different, but we're working on it. And if the best thing we can do to get approved is for people to express interest to their broker dealer and tell them they are interested in it. That will certainly help us, help you get access to it and us to get access to you and your clients.
So for the individual investors that are on today, can they buy the ETF unsolicited?
They both funds are available for purchase or sale when the New York Stock Exchange is open, where they both list, and they're available right now to be bought or sold, pending, you know, the rules or gatekeepers between the investor and their purchases.
All
So
right.
every broker, if you're talking about going through, you know, an individual calling their Morgan Stanley advisor, I think that might work, but I can't say specifically.
So on a non-discretionary basis, hey, I want you to buy the ETF EMQQ for, you know, my benefit, and that transaction goes through, right?
I think it can at some places, and there's probably some places where that simply can't go through. But I can't, you know, because there's hundreds of different variations on that story. Yes, but maybe not, depending on how strict the broker dealer.
So this next gentleman wants to know, you know, how much of FMQQ is India. Are you going to have any limit to how big you'll allow one country to be in the ETF?
No, we right now neither EMQQ or FMQQ have any limit. We don't have any country limits. You know, from the beginning, one of the things we considered was having a limit on China in EMQQ, but we wanted it to just happen in an unconstrained way, or with as little constraints as possible. So China's big in EMQQ. How big could India get in FMQQ? It could get pretty big. I don't think it could get as big as 65% like China is, at least not for a long time, maybe 15 years. That's theoretically possible, but I think probably not, because again, market caps being created all over the world. And while India's got a lot of people, excuse me, you know, there's a lot of people in Africa and a lot of people in Central and South America. So I don't know how big it can get. I do think that there will be a lot of IPOs out of India, and I think it could likely become 25% of FMQQ quickly. I think right now it's about 10.
It's about 10%. Okay. So next question's about the AUM of the two ETFs, EMQQ, FMQQ, and what are your fees for each of them?
Both of them have an expense ratio of 0.86%, 86 basis points. In the case of EMQQ, the New York Stock Exchange listed fund has about 1.3 billion US dollars. We also have a European UCITS offering that trades on various European exchanges that has another 350 million in it. And then in terms of FMQQ, I think it has like $3 million in it. And I think I might be the largest, well, I suspect I'm the largest shareholder, but slowly but surely other buyers are coming in. And, you know, we had a lot of success with EMQQ, but you know, it took a few years before it happened. And I suspect this one won't take quite as long, but you know, you run into the questions like, how big is the fund? Come back when you have 10 million, come back when you have 20 million, then you have the gatekeepers. And we have a lot of advisors at Morgan Stanley and UBS that are investors and long-term supporters of EMQQ, but they can't They can't get to FMQQ yet, but hopefully we'll get some walls knocked down here in the coming month or two.
So Kevin, you guys do an excellent job of the research and updating your investor base on the companies that you're putting into the portfolio that are already in the portfolio. Those research reports that you guys put out are excellent. I haven't seen anything like it. Is there any interest in sharing some of what's coming up in terms of the research reports that the group should be looking forward to in the near future?
Well, yeah, I think you'll see. I think there's a few things that we're working on. I mean, we're definitely going deep into India right now, and anyone that's interested, there's a fantastic book called India Connected, which talks about how the smartphone is coming or going, what's going on in India with the smartphone arrival. And it's not just, it's so powerful, and it's a book that does such a great job. Even the first chapter is all you need to read to go, okay, I get it. Like, this is really changing people's lives. So India is an area you'll see more from us. We'll probably do, we have this Let's Go update series we do to focus on both, whatever's going on in the news, positive or negative, that people are wondering about. We try to address those in this Let's Go series. But I think the first week of November, we'll do an update and have associated research on the India opportunity. Diwali is that week, and that's also when we think Paytm will come public. So you'll see India coverage from us. And then another project that we're working on, and we're so fortunate we have Akeem Bailey as our director of research now, because he's got a lot of firepower. We're kind of, when you think about emerging markets, right, and frontier markets, and I hope I'm not going to make everyone dizzy. I just want to go back to this one slide. Every country in the world gets put into a bucket. You're either developed, you're emerging, or you're frontier, right? And for many years, people have said, well, isn't China, how can China be an emerging market, right? It's the second biggest economy in the world. And I tell people, well, I'm not really in charge of that. I mean, that's MSCI. I mean, I can make my own definitions of these things, but no one's going to really care. It's MSCI and FTSE. And they're not exactly the same in their definitions, but they're, they, other than Korea, they're the same. But what I think we're going to do is we're going to look at the internet. Like, if we looked at it on an internet basis, like, are you an advanced internet country or a developing, emerging internet company? Because if you look at this side, if we were going to recategorize every country by its e-commerce market, well, China is the most developed in the world by far. I mean, it's kind of on its own whole level above everything else. So yeah, we're doing some research to think about if we were going to recast the global equity universe by the development of their internet and e-commerce markets, how we would categorize the world. So that's another interesting thing we're working on that may get done by the end of the year.
I love that. I love that. We have an ETF series, ETF forum. Our next one is in a little over 2 weeks. It's on November 4th. I would like to invite you back, perhaps to share some of the research, on India that you have coming up. Hopefully it fits with your schedule. I'll reach out to Kyle and see if we can coordinate things. When Nusi started with us last year, it had $40 million worth of assets under management. Today it has over 500 million, over $600 million. So I know FMQQ is going to be successful, and it'll be good to go on this journey with you. You know, I speak very highly of you. I call you the best of breed in this space, and I'm happy for those people that hung around to listen to your story today. It's always a pleasure having you on.
Thank you so much, Michael. That's so kind, and I appreciate those words, and pleasure to be here, and I'll look forward to being back.
All right. Thank you, Kevin. Have a great day.
Thank you. Thanks, everyone.
Thank you, everyone, for your time and attention today. We're going to have another ETF forum on November 4th. You will be receiving copies of the presentations and a recording and a way to download the decks. So with that, thank you for your time and attention today. Bye now.